Welcome to today's deep dive. Over the weekend, Bitcoin was racing toward that 80,000 mark and then just slammed into a brick wall.
Yeah, literally instantly dropped a couple grand.
Exactly. It grazed 79,480 and then dropped to 77,5 almost instantly. It was like watching a high-speed train hit reinforced concrete. So, was that an actual fundamental shift, or did traders just walk into a massive trap?
Oh, it was absolutely a trap. Specifically, it was a mechanical liquidity sweep. The market basically executed this systematic extraction of transient retail capital.
Wait, hold on. Mechanical liquidity sweep sounds like something a robot janitor does. What does that actually look like? Are you saying this wasn't, organic buying and selling?
Yeah, no, not at all. That sudden upward spike was fueled entirely by a short squeeze. Over 186 million in short positions just got totally squeezed out to create that synthetic high.
Oh, wow. That is huge.
Right, and it was immediately followed by 68 million in long liquidations. So, everyday traders who excitedly bought at the top just got wiped out.
Man, so retail traders are just getting chopped up in these derivative traps.
Yeah.
But if they're the ones losing out, who is actually accumulating right now? Who's on the other side?
Well, the institutions. They're quietly building this massive structural floor. Look at Hong Kong today. They just inaugurated their spot ETFs.
Right, and they're using that in-kind creation model, which is a big deal, right?
A massive deal, because unlike the U.S., where funds have to use cash, Hong Kong allows investors to literally trade their actual Bitcoin directly for ETF shares. China AMC instantly secured over 121 million in assets right out of the gate.
Yeah, and even in the U.S., ETFs are still pulling in, nearly $1 billion just last week?
Yep, nearly $1 billion.
Plus, you've got MicroStrategy bypassing the usual preferred stock friction, selling common stock to scoop up another 3,273 Bitcoin for $255 million.
Right. Traditional finance is actively, taking coins off the secondary market, but that brings up a glaring contradiction.
Well, yeah, if all these heavy hitters are relentlessly buying, why isn't the price skyrocketing?
Right, because there's this heavy macroeconomic ceiling pushing down right now. It's a dual force scenario.
It's like trying to fly a kite in a hurricane, honestly. The underlying mechanics work fine, but the environment is just completely hostile.
That is a perfect way to put it. On the domestic side, the U.S. bond market actually just breathed a huge sigh of relief. Senator Tillis dropped his blockade against the Fed chair nominee, Kevin Warsh.
Oh, so he's finally scheduled for a confirmation vote on Wednesday.
Right, and that drains a lot of artificial uncertainty out of the markets. But overseas, it is a completely different story.
Yeah, the geopolitical environment is triggering what you'd call a thermodynamic supply shock.
Exactly. Iran is demanding the U.S. lift its naval blockade before any nuclear talks, a kind of two-stage proposal. And they backed that up by attacking a chemical tanker, the MT Chiron. Plus, they're threatening, fourfold retaliation.
Wait, so the thermodynamic supply shock, you're talking about the oil market,
Yeah,
right?
so I am, yeah. With the primary global energy corridor basically paralyzed, Brent crude has spiked to $107.
Wow. 107.
Yeah, and because oil impacts the price of literally everything, that energy spike effectively locks in inflation.
Which ties the Federal Reserve's hands completely. As long as oil keeps inflation high, they just can't cut rates.
Exactly. That is the macro ceiling. You have the mathematical certainty of institutional accumulation pushing the floor up, but this unquantifiable chaos of global energy markets pressing the ceiling down.
So for everyone listening, you are basically watching a market completely trapped between those two massive forces. It's fascinating how much these immediate geopolitical threats dictate daily price action.
Oh, absolutely. But, while the market obsesses over Iran and the Fed, developers are actually looking decades into the future.
Right. And we want to leave you with this final thought. While everyone is staring at today's charts, developers are quietly testing something called BIP 360 on a quantum testnet.
Yeah, they're actively upgrading the code to natively protect the network against post-quantum computing threats. They aren't worried about next quarter's interest rates.
Exactly. So if the underlying architecture of this asset is already sortifying itself for the next century's existential threats, how long until traditional financial markets finally price in that level of technological permanence?